You know, when we think of an emergency fund, most of us picture this boring pile of cash just sitting there, waiting for a rainy day. But what if it's way more than that? What if it's the single most powerful tool you have for buying back your focus, slashing your stress, and honestly, just unlocking a better life? Let's totally rethink what this money is really for.
So what's with this number? 7.3 hours a week. Well, according to some really interesting research from Vanguard, that's how much time, on average, people with no savings spend actively worrying about their finances. Think about that. It's like a hidden tax on your brain, a part-time job you never even signed up for.
And check this out. This chart shows the incredible psychological payoff of just getting started. Vanguard found that having just $2,000 in liquid savings boosts a person's sense of financial well-being by a massive 21%. I mean, to put that in perspective, that initial boost is statistically similar to the impact of having over $1 million in total assets. It's not just about the money, it's about peace of mind.
Right, so that's 7.3 hours a week. It's not just lost time. Financial insecurity creates what researchers call a cognitive load. It's this constant, low-level stress that just drains your focus and your energy. It makes you less productive at work and, frankly, less present with the people you care about. Your emergency fund isn't just a safety net, it's a productivity tool.
So let's talk about the standard advice. We've all heard it a million times, right? From financial gurus, from our banks, maybe even our parents. It's that simple rule that has guided financial planning for decades.
The advice is to save 3 to 6 months of your essential living expenses. And for a long time, that seemed like the gold standard. But let's be real. In today's world of gig work, high-deductible health plans, and all this economic uncertainty, is that simple rule really enough?
Data from the Federal Reserve shows us why we need to dig a little deeper. Just look at the trend here. The percentage of adults feeling like they're doing okay actually peaked back in 2021 and has been dropping since. But what's even more telling is that classic $400 emergency question. The ability to cover a small shock with cash also peaked in 2021 and has now fallen right back to where it was pre-pandemic. This shows that even with some savings, a lot of people are still on really shaky ground. That one-size-fits-all rule, it's just not a silver bullet.
So, this is the crucial part. We need to move away from some generic rule and get to a personalized target. It's not about 3 months or 6 months. It's about figuring out the right amount for your specific life and your unique level of risk.
Let's just start thinking about where you might land on this spectrum. On one side, you've got a lower risk profile. Maybe that's a dual-income couple, both with stable, salaried jobs, renting an apartment. Easy peasy. On the other side, though, you have a higher risk profile. Maybe a single-earner freelancer who owns a home and has a high-deductible health plan. The amount of cash they need on hand is fundamentally different.
This table really breaks it down for you. Look at these variables. Is your income from a stable W-2 job, or is it commission or dig-based? Are you the only one bringing in money? Do you own a home with all its lovely, unpredictable repair costs? Every single variable on that right-hand side pushes your target higher, from that standard 6 months, maybe towards 9 or even 12. Okay, so once you have your personal target in mind, the big question is, how do you get there in the smartest way possible? Because it's not just about saving, it's about the order of your financial moves and how you actually structure your accounts.
All right, the absolute first step before you do anything else is to build what's called a starter emergency fund. I love this idea. Think of it as a small financial first aid kit. Its whole purpose is to handle those little annoyances, a flat tire, a surprise medical copay, so you don't have to reach for a high-interest credit card and completely derail your progress. It's all about breaking that debt cycle.
This right here, this is the expert-approved sequence. First, you build that starter fund. Second, and this is non-negotiable, you contribute enough to your 401k to get the full employer match. I mean, that's 100% return on your money. You can't beat it. Third, you aggressively attack any high-interest debt like credit cards. Then, you circle back and finish building out your full emergency fund to that personalized target. And only after that fortress is built do you really focus on long-term investing.
Now, as you're building up that full fund, there's a more advanced strategy to think about. See, once your savings get bigger, keeping it all in one low-yield account is actually a mistake. Instead, you can build a tiered financial firewall, which perfectly balances having immediate access to your cash with earning better interest rates.
So, Tier 1 is your first line of defense. This is cash you need to be able to get your hands on in minutes. We're talking about $1,000 up to maybe 1 month of expenses, kept right in your primary checking or savings account. The goal here is pure, instant liquidity. That's it.
Now, Tier 2 is the real workhorse of your emergency fund. This is where you're going to keep the bulk of your savings, about 2 to 5 months worth of expenses. The perfect place for this is a high-yield savings account, or an HYSA, probably at an online bank. You can get the money in 1 to 3 days, and you'll earn a much better interest rate than at a traditional bank.
And for those of you with bigger funds, you're aiming for 6 months or more, Tier 3 acts as an inflation hedge. This is the money for a really prolonged emergency, so it doesn't need to be available instantly. You can put it in things like treasury bills or CDs to earn an even higher yield, and, most importantly, protect your purchasing power over time.
So with this kind of structure in place, the whole concept of an emergency fund just transforms. It's no longer just this defensive safety net. Once it's fully funded, it becomes a stable foundation, a springboard that actually allows you to take calculated risks and build real wealth.
But there's a real danger in being too safe. It's this idea called cash drag, this invisible force that makes your safe money worth less every single year. It's the opportunity cost you pay for holding way too much cash that isn't working for you, while inflation is just eating away at its value. It's the hidden tax of being overly conservative.
Let's make that real for a second. What's the cost of cash drag? Well, if you held just $20,000 in excess cash for 20 years instead of investing it, the approximate opportunity cost is a staggering $57,000. That's wealth you simply left on the table. Gone. This quote really just sums up the entire philosophy we've been talking about. Financial resilience is not achieved by the size of the bank balance alone, but by the strategic alignment of liquidity, safety, and psychological preparedness. It's about building a smart system, not just hitting some random number. So that leaves us with one final thought. I want you to take a hard look at your own saving strategy. Is the cash you have on hand a true safety net, one that's empowering you to live with less stress and take smart risks? Or has it become an anchor, creating cash drag and weighing down your long-term goals?